Hey everyone, welcome back to the channel. In today's video, I'll try to answer a burning question. Could the United States-China trade war end soon? Important note, this video was created with the help of artificial intelligence. It is not financial advice and should only be interpreted as informative and entertaining content. Always do your own research before making investment decisions. The week started on a surprisingly optimistic note. Donald Trump announced that the United States automotive industry might be exempt from future tariffs. The stock market responded instantly. Ford surged by 4.1%, General Motors gained 3.6%, and Tesla rose by 2.9%. The S&P 500 automotive subindex jumped by 2.3%. This ripple effect wasn't limited to the United States. European car makers rallied as well. BMW and Stellantis both closed up over 2% in Frankfurt and Paris. The DAX also moved higher, largely driven by the auto sector. Meanwhile, semiconductor stocks rallied as markets began pricing in a decision announced last week. Trump had granted temporary tariff exemptions to U.S. chip makers like Nvidia, Qualcomm, and Broadcom. So, China's reaction? We welcome this as a first step, but real progress will require more than symbolic gestures. However, late in the day, Trump made headlines again. He floated the idea of tariffs as high as 245% on certain Chinese goods. Markets were mixed. Some traders viewed it as a bluff. Others worried it marked the next escalation. China's Ministry of Commerce responded, "The current tariff levels are already sufficient to restrict U.S. imports. We're not taking the new threats seriously." Do you think Trump will go all the way with the 245% tariffs? Or is it just a negotiation tactic? Let me know in the comments. On Wednesday, China officially appointed a new chief trade negotiator. Markets saw this as a sign of readiness to re-engage, and tech stocks opened strong. The Nasdaq rose 0.7% in early trading, but the optimism didn't last long. Nvidia shocked investors by reporting a $5.5 billion loss triggered by a recent U.S. government ban on exporting its H20 AI chips to China. In after-hours trading, Nvidia's stock fell 6%. The impact rippled across the sector. AMD and Intel both dropped 2 to 3%. One Reuters analyst summed it up pretty well. AI chip exports aren't just a business issue anymore. They're a front line in geopolitical conflict. So, what's your take? Should AI chips be considered strategic weapons, or just commercial products? Drop a comment and let us know your thoughts. On April 12th, China officially enacted the extra tariffs it had announced weeks earlier. These new duties affect hundreds of U.S. products, with rates climbing as high as 125%. But honestly, that wasn't even the most important update. China also rolled out a brand new tariff rule for semiconductors, and yeah, it's a real game changer. From now on, the country of origin will be determined by where the silicon wafer was manufactured, not where the chip was designed or packaged. So, in practice, if the chip's wafer was made in Taiwan, it may be exempt from tariffs. But if it was produced in the United States, it's subject to the full 125% tariff. That puts Intel, Texas Instruments, and Global Foundries at a disadvantage. Meanwhile, companies like Nvidia, AMD, and Qualcomm, which rely heavily on TSMC in Taiwan, gain a strategic edge. TSMC shares, by the way, jumped 3.2% in response. Chinese officials described the change as a fair and precise way to encourage diversified production and reduce dependency on US-based fabrication. So, is this fair policy or targeted retaliation? Let us know what you think and comment below with your take. On Friday, Federal Reserve Chair Jerome Powell finally addressed the trade war's economic impact. His message was blunt. Tariffs are fueling inflation and slowing growth. Markets tumbled in response. The S&P 500 dropped by 1.1%, and the Nasdaq fell by 1.4%. But Powell offered no indication that the Fed would intervene. No rate cut hints, no support signals at all. The markets, well, they interpreted his silence as pretty alarming. As CNBC analysts put it, the Fed is stepping back. There's no safety net under this market. And one Reuters editorial summed it up like this: we're facing 3 levels of uncertainty: Trump's tariffs, China's retaliation, and now a passive Federal Reserve. So, what would you do if you were in Powell's shoes? Would you stay on the sidelines or act? Let us know in the comments. And just a quick heads up, the following section was generated with the help of artificial intelligence. It's not financial advice, it's just my own perspective. Please, use your own judgment before making any investment decisions. In my opinion, this conflict isn't going to end anytime soon. Neither side wants to show weakness, so negotiations will likely be long, tough, and full of twists. We may get temporary positive headlines, like talks have begun or negotiations progressing well, and markets could rally sharply. But, just as easily, we could see negative news. Talks broke down or new tariffs announced, and then, well, markets would tumble again. So, what's your strategy in this kind of environment? Comment below, I'd really love to hear it. That's why I've decided to wait it out completely. I've sold all of my positions and moved to 100% cash. Here's how my fictional portfolio currently stands. Starting value, $15,000. Current cash balance, $14,714. Stock holdings, $0. Total value, realized plus unrealized, $14,714. And that's a change of negative $285.70, or about negative 1.9%. This was a conscious decision. My biggest advantage right now is flexibility. I can respond to new developments quickly. If markets shift positively, I can jump back in. If things escalate again, I won't take losses on open positions. For now, I'm simply watching and waiting. Do you think staying in cash is smart right now, or a missed opportunity? Drop your opinion in the comments. And just a quick disclaimer. The following analysis was created with the assistance of AI and is not to be interpreted as official policy or financial guidance. It's speculative and designed to provoke thought and discussion. In my view, these are the most likely demands each side, the United States and China, might bring to the table during the next round of negotiations. Even if these aren't fully accepted or agreed upon immediately, they will all likely be discussed at some point. That's why I don't believe these talks will end quickly. We'll get some positive headlines like talks progressing or China open to compromise, and, the market might surge, but we'll also face negatives, such as talks stalled or new retaliatory tariffs, leading to sharp drops and volatility. What do you think? Will they ever agree? Or is this just a slow-motion standoff? Let me know in the comments. Bonus: what might the United States and China demand from each other? Okay, quick disclaimer here. The following analysis was created with the assistance of AI, and honestly, it's not to be interpreted as official policy or financial guidance. It's speculative and really just designed to provoke thought and discussion. Now, when it comes to the negotiation process, these are the most likely demands the United States and China may bring to the table in any serious trade negotiation round. Even if these aren't fully accepted right away, they're almost certain to be part of the discussion. That's why the process won't be quick or simple. So, markets may jump on headlines like talks progressing or positive developments, but, any sign of breakdown could cause equally sharp sell-offs. What do you think? Will they find common ground, or is this a geopolitical standoff with no end in sight? Share your thoughts in the comments. Alright, so what might the United States demand? First up, trade balance reform. The US will likely demand that China increase its imports of American goods, particularly agricultural products like soy and corn, industrial machinery, and LNG. The goal here? Reduce the trade deficit, which was over $350 billion in some years. So, let's talk about intellectual property protection. American firms, they really want reliable protection for their patents, trademarks, and proprietary technologies. The United States may also demand that China stop pressuring foreign companies to share technology as a condition for market access. And then, there's the issue of curbing state subsidies in tech. Washington has criticized China's government subsidies for major tech sectors like artificial intelligence, semiconductors, and electric vehicles. The United States may call for reduced support, or at the very least, more transparency in how those subsidies are distributed. Next up, the United States wants a level playing field for foreign companies. That means American firms should have equal access and treatment in the Chinese market. This includes ending discriminatory regulations and making sure foreign businesses get legal protection and proper enforcement. And then, there's the whole issue of a transparent currency policy. The United States has accused China of manipulating the yuan, so future deals may require China to publish clear exchange rate policies and avoid any deliberate devaluation to boost exports. Now on enforcement mechanisms. To ensure compliance, the United States may insist on automatic enforcement tools, like snapback tariffs if China breaks the deal, without having to renegotiate. And finally, access to rare earth elements. Rare earths are just essential for defense, clean energy, and electronics. The United States wants reliable access, or at least a framework that prevents China from weaponizing its near monopoly in this area. So which of these do you think China would actually consider acceptable? And, which ones are just total red lines? So what might China actually demand in these negotiations? Well, first up, full tariff rollbacks. China's top priority is to eliminate all additional tariffs, especially those Trump-era duties that at their peak reached as high as 145% on certain categories. From Beijing's perspective, these tariffs are seen as politically motivated and honestly pretty economically destructive. Next, lifting tech export controls. Beijing is looking for access to high-end US technologies like advanced chips, AI hardware, and design software. These tools are really critical to China's ambitions in artificial intelligence, biotech, and semiconductors. Another big one, market access for Chinese firms. Companies like TikTok, Huawei, and Alibaba want to operate in the US without being blocked under national security laws. China basically sees this as protectionism, just with a different label. And then, there's the removal of sanctions and blacklists. China will push for Washington to take key companies and executives off lists like the Entity List, the SDN List, and other export control rosters. Next on the list, China may ask for cyber and data rules to be relaxed. That means fewer restrictions on things like cross-border data flows, cloud services, and digital infrastructure, especially as digital trade becomes more and more central to global commerce. And finally, a return to the WTO framework. China wants all disputes to be settled through the World Trade Organization, not through unilateral action. That includes restoring WTO arbitration and really dialing back on the use of Section 301 tariffs. So, which of these demands do you think the US might actually be willing to accept? And where do you think compromise is just impossible? Let's discuss.